Every time the Fed talks, we get an uneasy feeling in the pit of our stomach. The same uneasy feeling we get when waiting that 2 to 3 minutes to see if the little pea stick is going to change our life forever. Or when your ex texts you that they miss you at 3 a.m. Or when you have to do the walk of shame in last night's dress and leftover makeup. Yeah, that's the feeling that the Federal Reserve gives us. If you guys are new to my channel and don't know who I am, my name's Leah Bunning. I am a mortgage broker and certified mortgage advisor. And if you find this video helpful, please like and subscribe. Today, I'm going to be going over why the Fed has been raising the federal funds rate and how that's going to be impacting your mortgage. One thing you guys have to understand about the Federal Reserve, or as I like to call them, the Fed. The Fed has something called a dual mandate. Basically, this means they have two main goals or objectives. These are price stability and maximum employment. So this means their goal is to keep prices here in the United States stable, and while also maintaining high levels of employment. Now, the federal funds rate is one of the primary tools that the Fed has to help keep this dual mandate. And the federal funds rate is just the overnight interest rate for banks to borrow money. Something else you guys should know about the Fed. They're really bad at their jobs. I mean, really bad. I think part of this is because they're usually career politicians or attorneys. They're not economists. Most of them, if any of them, have never owned a business a day in their lives or run a business. They just don't know what they're doing. The job titles do not coincide with each other, and they like to take things to the extreme. This is why here in our economy we see such boom and bust cycles. It's because the Fed just doesn't know when to stop in both directions. Put a pin in that because that's an important concept to keep in mind. The Fed plays a big role in the direction that mortgage rates are going to go. Let's rewind a little bit and let's go back to 2020. I'm sure most of you guys remember when mortgage interest rates dropped into the 2s and the 3s. I want to reiterate, the federal funds rate is not the same thing as mortgage rates. But where the Fed really did come into play in influencing and moving the mortgage rates was that they were buying billions of dollars in mortgage-backed securities back in 2020. When the Fed did this caused the price of mortgage-backed securities to jump up dramatically, which in turn brought the interest rates down into the 2s and the 3s. But the Fed kept mortgage rates low for way too long. And I know that sounds terrible because I know I got to take advantage of the rates being in the 2s and the 3s, but they really should not have been that low, and especially that low for that long. And we're just starting to see the unintended consequences of that. So when the rates were in the 2s and the 3s, that's also partially what led to and helped create that housing market boom that we experienced. Not just the housing market boom, but everything else went up in price. Inflation. Inflation was going through the roof. So going back to the Fed needing to maintain what? They have their dual mandate, price stability and maximum employment. There was no price stability. Our prices were all over the place, not just goods and services, but in the housing market as well. Prices for homes just skyrocketed. And the Fed let it go on. For a long time, they just kept purchasing mortgage-backed security. They just kept buying. And they kept saying inflation is transitory. It'll just go away on its own. We don't need to do anything. And they took it too far. When the Fed finally realized that they took it way to the extreme and they let inflation get way too far ahead of them, now they had to reverse. So what did they stop doing? They stopped purchasing mortgage-backed securities and they started to raise the federal funds rate. This is why in 2022, mortgage rates jumped up very quickly, because mortgage rates tend to follow inflation. And inflation was sky high and mortgage rates should have been there too. But because of the Fed's little meddling in things, it was keeping them low. Fast forward into 2023. The Fed, as we know, has been hiking the federal funds rate and mortgage rates have been staying high. They have not come down. And this definitely is going to impact how much home people can afford to get and purchase. Now, at the Fed's most recent meeting this year, on September 20th in 2023, Jerome Powell, who is the chairman for the Federal Reserve, told everyone that they were going to pause on hiking rates during this meeting. However, during the press conference, this is what he elaborated on. He said, "We are prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we are confident that inflation is moving down sustainably toward our objective." What does this mean for your mortgage? I'm in the mortgage industry. I see this stuff all day, every day, and I can say after that press conference, the mortgage market didn't like it very much. Because what Jerome Powell is saying is that, one, he's saying that there still might be more rate hikes later this year. And he's also saying that they anticipate keeping rates at a higher level for a much longer period of time. And mortgage rates just didn't like that news very much. And this is where the Fed has to be careful though, because of those boom and bust cycles. They let inflation get way too far ahead of them before they started doing anything about it, right? They were buying mortgage-backed securities for way too long. They kept the federal funds rate low for way too long. But now, are they going to go too far on the opposite end? Raising rates maybe too quickly, too fast, or keeping them too high for too long? What would this do? This would create a recession. We're already seeing indicators for one, and I wouldn't be surprised if we do end up having one and an official one's called in the near future. There's so many more details and moving parts to this that I would love to share with you guys. But for today, this was a lot of good information. We're just gonna do little baby bits of food at a time. But make sure to subscribe because next video, I'm going to take you guys on a tour through time where I'm gonna show you just how unaffordable the Fed and the government have made the housing market for middle-class America. Stay tuned, and I will see all you lovelies later.